Joining us today is Joe Mazzola, our head tradings derivatives strategist at Charles Schwab, and Kathy Jones, our chief fixed income strategist at the Schwab Center for Financial Research. Now, starting with you, Kathy, I just want to get your takeaways on the data we got this morning on the PPI numbers.
Yeah, it came in below expectations, considerably below expectations, with some downward revisions to the previous month. So that was certainly welcome news on inflation. I will say, though, that there's some caveats to it. Much of the decline in prices was seen in actual profit margins and more in the service sector, particularly medical care, and not on the goods side where we actually saw increasing price pressure. So it's a little bit of a mixed bag, more than the headline numbers would suggest, but it certainly opens the door to the Fed cutting rates at their meeting because clearly, it's a good inflation print. It should translate into a good inflation print for the personal consumption expenditures index, which is the one the Fed typically uses as a benchmark when it sets policy.
And Joe, I'd like to get your takeaways as well, what your thoughts are on the report.
Yeah, I think Kathy pointed out something that's really important, and that's profit margins. And whether or not those profit margins that we're seeing on the services sector, whether or not those continue into the Q3 earnings data that we're going to get basically starting off in a month or so. And that's going to be important because you could make a case, and you can make a strong case that heading into the Q2 earnings, there was an expectations that margins would be narrowing. They didn't. If anything, they expanded, and I think they probably provided some fuel for that additional leg up that we saw in the last couple months. So that's something I'm going to be keying on. I think it's also important when you look at that kind of also through the lens of Oracle's earnings last night. That gave a nice little boost to the AI demand story. And when we think about profit margins, profit margins continue to really be driven by the AI and AI adjacent names and the tech sector, and mega caps as a whole. They're the ones that have continued to expand and continue to kind of bring up the rest of the market with them.
Yeah, it's certainly a true story there with that AI demand, and it just continues to rise in the CapEx spend. But I want to stay on this Fed talk about PPI and upcoming CPI before we move into equities. Kathy, coming back to you, with the data that we got today, do you think that this raised hopes of a higher basis cut than 25 basis points?
Yeah, the market is now putting a fairly high probability on a 50 basis point rate cut at the September 16-17 meeting. I still think that that's a bit of a stretch, although it's not out of the question. The Fed has said that they think that the current policy stance is restrictive. Probably, I would guess, in their minds, it's around 50 basis points higher than it needs to be, given the deterioration we're seeing in the labor market. But we still have inflation pressures as pretty resilient here, and a lot of policy uncertainty going forward. So I think 25 is still the more likely outcome at this meeting. It gives the Fed more optionality. They could cut 2 more times this year because there are 2 more meetings this year after September. They have the option to do more, to do less, to kind of try to really time this, the magnitude and pace of rate cuts going forward. So I think the market's a bit ahead of itself, but remains to be seen. There's a lot going on at the Fed right now. So a 50 basis point cut isn't out of the question. I just don't think it's the highest probability.
And Joe, I want to come back to what you were saying about, the AI race and AI demand story continuing to drive the markets here, particularly with Oracle, and their really impressive gains on the day, still holding on up more than 36% right now. We saw such a huge surge in their book and their remaining performance obligations here, but also in the CapEx spend. And I want to get your thoughts on, we've seen, as they were the last to report, we've seen this heavily increased CapEx spend coming from a lot of these tech companies, particularly these cloud services companies. And is there a pressure for everyone to increase CapEx because everyone else is doing it? And do we have to have a cause for concern there at some point?
Well, there's a pressure to rotate that spending out of something else towards AI, right? And I think that that's important and to look at in terms of, the employment picture. Does that mean that you see a slowdown in hiring because of that, those funds being rotated into the CapEx for AI? I think that makes sense. And I think that a lot of companies are looking at AI as a driver of productivity going forward. And I think, from the picture of just the United States as a whole, I mean, we should be looking at that as a driver of productivity, that this could be a game changer in the next 5 to 10 years. And, we're pricing it in right now. I think the other thing that's interesting from a pricing standpoint is just kind of looking at what we are willing to pay for that. Maybe not just per se on what companies are willing to pay, but what are investors willing to pay? At these levels now, we're getting to an area where equity risk premium, which is basically the amount that an investor will demand for taking on equity risk over, something like Kathy talks about, like corporate bonds and treasuries. That's dwindled. I mean, it's basically nothing now. And it's negative if you look at the difference between something like an earnings yield on the S&P 500 versus what you can get for a 10-year. That's a negative number now. And it's important in this context. It's important in the context of you only have a certain amount of funds to allocate. Where are you going to allocate them? And if you decide that you're willing to do that, and more so in the equity market, well, now you're foregoing what you could be doing for in the fixed income and vice versa. And I think at some point we're going to hit that inflection point. I don't know if we're there yet, but that's just usually a way to kind of look at the market from valuations outside of something as basic as a PE.
Well, we appreciate you both joining us for our Schwab panel today. That's Joe Mazzola from Charles Schwab and Kathy Jones from the Schwab Center for Financial Research.